Talk about investing for kids because there are a lot of parents that listen to us, and you keep saying like, "I got my son's invested in this, and I got this." Like, how do you do that? Some people are going to be getting into the game for themselves, but now they also just heard you say how you currently are investing for your toddler, trying to set him up for the future. So break that down. How do you make that happen?
Yeah, so this is why I brought up Fidelity as one of the first ones that came to mind because someone said like, "What about Robinhood and what about these other apps?" Those are only for individual accounts right now, so I can only help myself there. But Fidelity has what we call custodial accounts, which means that I can invest on behalf of my son when he's 18 or 21, depending on your state. That money becomes his. So what I'm able to do, open up his account, put in as much as I can, choose any index fund or stocks that I want, and allow it to grow over time. And the older he gets, the more involved I want to get him into it. So he's picking his own stocks. He's getting used to managing his own money. And when he's ready, he can take it and manage it on his own.
Oh, okay, now that's dope. So if I want to get for me, I open up a
Hmm.
traditional brokerage account. If I want to get for my kids, I
Hmm.
open up a custodial brokerage account.
That is correct.
Dope. Now, somebody talked about fees. You want to talk about that when you are making buys, snatching up whether that's traditional or fractional shares,
Hmm.
or getting it for yourself or getting it for your kids. Are there some fees we need to be aware of when we're transacting this way and trying to enter into the stock market?
Great question. For transactions, generally there are no fees, not anymore, especially with the Fidelities, with the public, even with Robinhood. They're actually the ones who started this whole thing where when you buy and sell, there are no fees. It used to cost, again, back in the day, 2010 or so, it used to cost $10 every time you buy and every time you sell. Nowadays, in most places, you're not paying anything to buy and sell stocks or ETFs.
Nice. Okay. So you talked about Fidelity as a good place to start if we want to do not just us, but some family oriented. Some people are on here single and they're just trying to get themselves in the game. Is this a good time to get into the market? Like, take the news that we're just talked about with Tesla and Apple.
Hmm.
Prior to that, if we were looking at financial news, it was like kind of doom and gloom when it came
Hmm.
to the stock market. Made it seem super scary. Made it seem like maybe this ain't a good time to get into the
Yeah,
game.
it did.
Since you're not new to this is what you've done professionally for quite a while. What do you say to people who are wondering, is this a good time to get into the stock market?
That is a great question. So my answer is still the same, and it was the same in March when things weren't looking great. The answer is yes. It is always, in my view, is always a good time to invest. It just depends on what you happen to invest in. And the reason why we say this, or the reason why I say this, is because the wealth that is going to be created in 2030 and 2040 are the people who are investing right now. The people who are wealthy in 2020 were the ones who invested in 2008 and 2009 when it was not pretty to do so. And even going back to March, we actually came back. I think it was actually on Friday. We actually broke even. That was one session since 2008, and we've already recovered from it from a stock market perspective. So the key is, again, 10 years ago, you're going to wish you started 10 years from now. Everybody here wishes they would have invested in 2010. Everything was cheap in comparison now. And 2010 wasn't always the best year. We're 2 years removed from 2008. Like that, everybody back then would have told you this isn't the best time. People in the dot-com bust, they would have told you the exact same thing. This is not the time to invest. It was the dot-com bust. It was 9/11. That's just not the time to invest. However, those that did profited greatly at this point in time. So again, the wealth is going to be created in 2030 and 2040. This is the time right now. It's going to take time. Doesn't mean it's going to come up every single day or that it's going to go up in a straight line. But those who invest over time are usually the ones that do the best.
Dope. Now, comments are going crazy about the term index funds. So, for everybody that's asking, and this is very similar to someone else asked about an ETF. All right. Index funds are a type of mutual fund. So, we started this conversation talking about individual stocks. Individual stocks is when I buy a share of one company and I'm invested in that one company based on that share. If the company does well, my money does well. If the company doesn't do well, my money doesn't do well. A traditional mutual fund is a collection of companies inside one fund where I can put my money into this fund and my money, my risk gets spread out amongst these companies. The next level is index funds. That's what Kevin kept referring to earlier. An index fund is a type of mutual fund, but the difference is it is a fund based on all the companies that are on a particular index. An index is something like the S&P 500. You may have heard that term, or NASDAQ. You may have heard that term. Those are indexes. And so every company that's on that index, if you get an index fund that is tied to the S&P 500, when you put your money into that fund, it's spread out over every last company that is in that index. And so it brings your risk down a little bit more. Index funds are not trying to beat the market, they're simply matching the market. So whatever the market is doing, that's what your money is doing. Are there any other nuances that I'm missing, Kevin, when it comes to index funds versus traditional mutual funds versus individual stocks?
No, no, but I do have an example that I think will resonate a lot. So I'm assuming that you are a Chicago Bulls fan.
Is there another team? I don't know any other team than that.
All right. Well, you're a Chicago Bulls fan. I saw someone from Detroit earlier. The way I like to explain it is buying an individual stock is like buying the Chicago Bulls. Maybe they're good, maybe they're not. You never know, right? But an index fund is buying the entire NBA. So it really doesn't matter who's in the bubble. It doesn't really matter who's going to win the championship. I own the entire league. So that's the difference. So it spreads everything out across the teams or the index versus hoping and praying that this one stock does well or that your specific team does well. So that's how I explain the difference between an individual stock in one team or an index fund in the entire league.
Yeah. So for us personally, you guys, if you've been rocking with us for a while, you know that our foundational investment philosophy is index funds. But as of late, we've been saying maybe we need to add on top of all the index fund investing that we're doing some individual stocks. And so Kevin is a super trustworthy voice and has a super high knowledge in this area. That's why we brought him on to share his knowledge with you. So, what's your personal philosophy? You talked about 5% of the overall picture being in individual stocks. So, for you, how do you bake your stock market cake?
Yeah, that's a great question. So for me, I have a good chunk of my money in index funds because it's difficult to remain non-emotional and to choose and try and choose the best stocks all the time. So for me, I would say close to 80% of my money that's in the market is in index funds. That extra 20%, that's where I'm going in and choosing individual stocks and trying to get just a little bit better than the overall market. And the reason that I personally do that is because in some cases, like an Apple is going to do, or at least in the past, Apple has done a lot better than index funds. But also, when the market dropped, it was stocks like Walmart, Costco, Dollar General that actually went up during that time. So it kind of protects me a bit as when the market drops, those kind of stocks kind of protect me. So I'm not losing nearly as much as the average investor would.
So, and so, what do you say to those who are strictly like, I heard you're only supposed to do index funds. You shouldn't do anything other than index funds. Even though yours is 5%, you said individual stocks. Some people are just, and we've been in that mindset for a long time too, until recently. Index funds, index funds, index funds. Why is it a better option to have a good chunk in index funds, but also throw individual stocks into the mix? Why is that a thing? Why should that be a thing?
As someone who has seen 140 million, like have managed both sides of the house, if you will. So there is no right or wrong way. I've seen millionaire investors who only do index funds. I've seen millionaire investors that do individual and index, and then some that don't do index at all. So I don't like to say that there is one that is better, but there is one that is less stressful depending on who you are. So the advantage of index funds is set and forget it. It's easy. I don't have to hope or guess. I know what index funds generally do. The advantage of doing individual stocks is that I can make, depending on what you choose, a little bit to a lot better than the overall market. And when the market goes down, depending on what I have, I don't have to take that loss in the same way. For example, like I was saying, Walmart, Dollar General, Costco, when the market crashed back in, what was it, March, April-ish, those actually did really well. And because I had that little slice of my money there, I didn't lose the 22,000 that the average investor did across the board. So that's the pros and cons of having on each side.